Now, what I'm talking about today is peace of mind. And that's a critical part of everything that I'm talking about today, because one of your major concerns as parents, for example, for your daughters, is what happens when you are the carers, of course, what happens if you pass away or are otherwise unable to act for your daughters financially. So that's what we're talking about today. So what I'm going to run through today is all sorts of options and strategies for you. Now, I must run through this slide, but I want to anyway, and the reason for this is that please don't take this as rote. What I'm doing today is throwing all sorts of ideas, strategies and options your way. Don't just pick them up and run to your lawyer and say, this estate planner I saw the other day said I must do this, okay? It's simply throwing them your way for you to think about. But it's really important that you get particular and specific advice in relation to these areas. Okay, so what are we talking about today? Very quickly, I'm going to talk about AET, but very quickly. And the reason I'm doing that is because a lot of what I'm going to be talking about today will not make sense unless I explain who AET is and how they work. Secondly, estate planning, to give you an overview in relation to what it means and most importantly, what you should get out of that estate planning process as well. Thirdly, I'm going to go through testamentary trusts. Have you heard what these things are, testamentary trusts? Okay, so I'll explain those to you. And the point here is that don't be afraid of them. They are fantastic things. So as I say, I'll explain those to you. And fourthly, a case study, so that you all can relate to what I'm actually saying without standing up here and blurbing at you. And lastly, with questions, with time, I should get time at the end of this to take questions from you. So please bear with me. If we don't get that far, please understand. Okay, who's AET? AET is a trustee company. And what we've done for many, many years is work with families like yours for your family's peace of mind. We've been doing it for a long time, and what we do is work in with what your requirements are. So it's a trustee company. Now you'll see when I go through some of these strategies that, again, there's all sorts of options there. And you might think, well, I don't want a trustee company involved. And that's absolutely fine. But it just means that often when we work with families like yours, that it's a real blessing for some of those families to have somebody who's truly independent, who can act for your daughters when others perhaps may not be able to or may not be appropriate to. Okay. So AET, okay, so really they can be a trustee for anything, and you'll see again some of the strategies involve being that trustee, but also as attorney as well. And that's really important because it means that, for example, a person who is still alive would need an attorney to make those financial decisions for them as well. Okay, but again it comes down to somebody in that role as trustee or attorney who's appropriate for those circumstances. And as I say, if it doesn't suit your circumstance to involve someone like AET, an independent trustee, fantastic, okay? But it's always there as an option anyway. Let's talk about estate planning. What is it? Estate planning is a lot of things, and normally, like I said before, it's making sure that if you're not able to anymore, then your daughters are looked after financially. Now you'll see that note at the bottom there that it's quite different. The role as trustee or executor, for example, is quite different to the role of guardian. So the trustee role is financial in nature, whereas the guardian role is where you have somebody making health, medical and lifestyle decisions on behalf of your daughter. Now, most of you will say, well, I do that now. And of course you do as the parent. But the question again is, what happens if you're not able to anymore? Who is in that role? So the point here is that, again, I'm talking about the financial side today. But the financial side must work hand in hand with that guardian who makes those health, medical, lifestyle decisions. Okay, coming back to estate planning then, the financial side. What's it all about? And the first and most important probably is listening to you. And I say that because most lawyers are terrible at listening. I don't know whether you've experienced that, and hopefully there aren't too many lawyers in the room, but they are terrible at listening. They have an idea in their mind to say, oh, you fit this box and that's what I'm going to give to you. But that's not what it's all about. It's about listening to what your requirements are and working a strategy or throwing options your way around what your requirements are. And that brings me to the second point as well, expertise. Estate planning is very much an expert area of law. Most lawyers will put up their hand and say, yes, I'm an estate planning lawyer, but be very cautious. Most lawyers, as I say, can draft a will for you, and they might say they are estate planners, but there's a handful of us around the country that specialise in this. So as I say, be very cautious of a lawyer who says, yep, I'm an estate planner, I can do this for you. Ask the necessary questions. And some of those questions I'll throw your way today, because the strategies we'll be talking about today, many of which only an estate planner will be aware of. Okay? I'll come to that in a moment. The last one, strategies and options. Like I intimated before, estate planning is not about you sitting down in front of a lawyer and saying, yep, from that lawyer, that you must do this. It's about saying, again, listening to you, seeing what your requirements are, and that estate planning lawyer then saying, well, okay, that presents you with a number of opportunities or strategies or options. And here they are, A, B, C, D, E. And it's a matter of you choosing what strategy or combination of strategies you'd like to run with. Okay, and again, you'll see what I say today and it'll give you an idea of what strategies an estate planning lawyer who you're sitting in front of should be throwing your way. Make sense so far? Okay, good. Now, can I say also, estate planning. I've had a word to a number of you today, and it's quite clear that the common message is, oh, I must get around to doing this. And you're not special, okay? Most clients I see say that exact same thing, okay? But your requirements, of course, are great. And if you've put it in that bottom drawer, then please, whether you use AT or your own lawyer, I don't mind, as long as you get that expertise and as long as you do it, and do it sooner rather than later. Okay? Because really, you've got an opportunity to do it now while you're willing and able to. You don't want that to slip. And there are easy ways to do it. So it's not talking about, high-level strategies at all. It's about putting something in place. Okay, testamentary trusts. Now, I don't know how many of you have heard this term before, but don't be afraid of it. If I was sitting in front of a lawyer and that lawyer said testamentary trusts to me, I'd go all goggle-eyed and think, oh, what does that mean? Okay? It's like accountants say certain things to me every financial year. But a testamentary trust is not something to be afraid of. All it means is a trust set up in your will. And it means, and I'll go through this in a moment, it means that you can draft all sorts of things in your will. But like a normal will, a testamentary trust will not happen until you pass away. I say that because most clients I see walk into my office and say, oh, I thought a testamentary trust is a separate trust we set up now. But it's not at all. It's simply a will. And therefore, like any other will, as I say, it's only established when you pass away. Most important. Make sense? Good. So what are they used for? Okay. As it says there, all sorts of things. The magic in these things is simply it's in the drafting. And that's where that expertise in an estate planner comes in as well. Because there are easy and bad ways to do it, and good and expert ways to do it. Okay, so be very cautious. And as you'd imagine, I see lots of documents which have been produced by lawyers who are so-called estate planning documents, and they have been absolutely stuffed up. Okay, so again, be cautious to make sure you're getting that expert advice. So what are they used for? As I say, all sorts of things. Things like they can be fixed, meaning fixed for income or capital protected trusts. Or they can be flexible. You know, like people have family discretionary trusts. They can be just like that, where a trustee in control of that trust has full discretion as to what they do with the capital being produced from the trust, as well as the income being produced from the trust. Okay? And lastly, they're often used for things that we'll be talking about today, where we have a beneficiary and she can't look after those affairs herself, for example. Okay? So that's what we're talking about today. And again, it's a matter of drafting that testamentary trust to suit your circumstances. So the point here is, don't be afraid of these testamentary trusts. They are quite simple. So what are the common types of testamentary trusts then? Okay, I put some up here just for our purposes today. And the first one is that discretionary one I just referred to. And sometimes that works. And sometimes it's not so appropriate for our requirements. But remember, again, these are trusts set up in a will. So again, that discretionary trust would simply be a discretionary trust set up in a will. The second and third there are interesting, and these are ones we're going to be exploring today as well. Now, the protective trust I will explain in more detail, as I will in relation to those special disability trusts as well. So I won't jump the gun there. But what I want to refer to mainly in this slide is the use of super. Now, super is one of those things which is widely misunderstood by both lawyers and us generally as a whole, people as a whole. And it's one of those things that unless you see a proper estate planner, an expert, they won't understand the ability to use super in a very tax efficient way. And you'll see why I say that in a moment. But the point here is that you have to realise that super normally doesn't form part of your estate at all. Normally it's quite separate. So if you pass away, your assets are over here. They're the assets that you own in your name. But then you've got your super as well. So your super doesn't automatically get paid to your estate and go to your beneficiaries. You have to make sure that you do certain things with your super. And that's where those nominations come in. Now, I'm sure you've heard of those nominations, and that's where it's most important you get that proper advice. Now, why I'm referring to that in this slide is because for your daughters, we have a unique opportunity to treat them advantageously by using super. I'm going to refer to a pension in a moment, but what I'm referring to here is use of that super as a lump sum. So, mum and dad, I'm knocking you off, okay? How do we look after your daughter? And it means that if your daughter is financially dependent on you, then it means that that daughter can receive that super tax-free. Whereas normally, for example, for, say, able-bodied children over the age of 18, not financially dependent, they can't receive it tax-free. So the point here is that there's a way here that we can use super as a lump sum in a very tax-effective way. And this refers to a super death benefits trust, which is a trust within a will, which means that we can pay the super to the estate. Okay, so you know how I said before, normally it doesn't. In this case, we can make sure it's forming part of the estate, controlled by the will, but to use it to look after your daughter in a very tax-free, tax-effective way. So that's the lump sum I'm referring to there. Okay, let me introduce to you a case study then. And hopefully you'll get a good gauge as to what I mean by, as in the practical applications of what I'm referring to. Now, meet John and Jan. And please forgive the word disabled there. What I mean by that is, and I want to explain it, is that That term in the legislation I'm about to refer to refers to intellectually disabled as well as physically. But if a daughter of yours, for example, is able to look after her own affairs, then it means that would solve many of the issues, meaning we don't probably need a trustee for her. But of course, many of you will have your daughters where they're not able to, of course. And that's where that becomes so important. The question, therefore, is who would look after your daughter to make sure that she's looked after financially? Okay, so the family here is John and Jan. They've got Jamie, and Jamie has two, a brother and sister, and they are able-bodied children. Okay, so, and Jamie's brother and sister, in the whole scheme of things, as adults, are very willing to put up their hand and say, yep, I would like to look after Jamie if you, mum and dad, aren't around anymore. And the question there, I suppose, is that appropriate? And look, it's great. And we love the fact that they would like to look after Jamie in this case. But are they able to? Firstly, do they have the expertise? Secondly, do they have the time, for example? Because in my experience from dealing with and working with families like yours over many, many years, yes, of course, they'd love to do that for Jamie, but they just can't do it because they don't have the time. They have their own families, for example, to look after. And therefore, it's a matter of, well, do we look at other ways to look after Jamie financially? And thirdly, and interestingly, I've had a chat to some of you today as well, that sometimes if we have the brother and sister looking after Jamie, then are they the right people anyway to look after Jamie? Because it may be that they receive a financial benefit by looking after Jamie. Meaning that yes, they like the idea of looking after Jamie, but their sole reason for doing that is that they might benefit from that as well. Now, that's not a very nice thought, okay? But as I say, in my experience, I see a lot of that in the families that I work with as well. Okay? So again, it's one of those things to consider in your family, in your particular circumstances. Okay, so that is the family. Quickly looking at the assets, and forgive me if this has no reference to you at all, but just so that you've got some idea as to what John and Jan own, because this is important. And the most important point here is that we've got money in super. And so when I come to the strategies we're talking about, you'll see how important that is. Okay, let's talk about the strategies and options. John and Jan walk into my office, and what do I put in front of them for them to consider in their estate planning for looking after Jamie? And, of course, looking after their other two children as well. What I would talk to them about is, firstly, the protective trust. Again, I'll go through that in more detail. Secondly, I'd talk to them about a special disability trust. And I'll explain that in more detail in a moment as well. Then I'll talk to them about super as well. Now, this super side, as I'll talk to you about in a moment, is getting into more high-level, cutting-edge estate planning. So really, again, if you have your own lawyer who you'd like them to do your estate planning for, Jamie, for example, then make sure they understand the implications of using super as well. Okay, what about an independent trustee? I've put that up there. Again, we don't push AET as a solution. But again, working for AET, one of the benefits is that AET is there as a backup if, for example, you need a trustee company. And I say that because I used to be in a boutique city firm in the big smoke in the city, doing exactly the same as what I do now in a private law firm, but there was no ability to look after, say, Jamie in this case, because there was no independent trustee sitting behind that lawyer. So again, it's part of that discussion to say, look, if you need an independent trustee, then somebody like AET can step into that role. But as I say, it's not for everyone, and that's absolutely fine. Okay, Centrelink. Why is this so important? And why do I say there that it's the starting point? I say it's the starting point when we're talking about options and strategies, because one of the key drivers often is preserving the Centrelink benefits. Why? because we might just be replacing one income from the estate, for example, with another one, so replacing the income coming from the Centrelink with another one coming from the estate or the super. So why is that important? But of course it's important because it's not only the income stream which is important, it's the benefits which flow from the Centrelink. Okay? So accommodation, the pharmaceuticals, the other benefits which you'll be far more aware than I am. Okay? Sometimes they are so crucial to preserve the Centrelink pension, and therefore that's why it's often, as I say, a starting point. Because if the parents come and see me and they say, we don't care about Centrelink, then it opens up these doors. But if they say, no, at all cost we have to preserve Centrelink, then it means we flow down this route. And that's something I'll explain today when we look at the case studies as well. Okay, let's look at the first one then. The first option we put in front of John and Jan. And this is the easy one. This is a protective trust. Now, those of you who have seen a so-called estate planning lawyer, they've probably thrown this in front of you because it's the default mechanism for looking after, in your case, your daughter, for example. And what that means is that we simply have a share of the estate which is in a trust, a testamentary trust, and the protective trust means simply that, in this case, Jamie is the beneficiary, but we have a separate trustee or trustees looking after her money through the estate. It's pretty simple. Does that make sense, explaining it that way? It simply means that, a protective trust simply means that, in this case, Jamie is not in control of her own funds. But I say it's certainly a piece of the puzzle. But in a lot of ways, it's, as I say, the default. And in a lot of ways, it's a lazy default mechanism. Because one of the downsides is where a lawyer is throwing a protective trust to you, then the Centrelink benefits must be considered at all cost. And what often is not understood is that in this case, if Jamie receives a certain share of the estate, then does Centrelink then attribute that third share of the estate for Centrelink purposes, for means testing purposes? And the answer is, of course, yes, they do. So, as I say, often lazy drafting without having regard to the impact for Centrelink. Because if we throw in 900 grand into a protective trust through a will, yes, sounds like a good idea because of looking after Jamie financially, but we've blown her pension. And often that's not found out until too late. So the point here is that a protective trust is a tool, but should be simply, as I say, a piece of the puzzle. So those of you who have seen your so-called estate planning lawyer and have plonked a whole lump of money into a protective trust, go home and consider that Centrelink issue in relation to it. Make sense? Good. Okay, so to use that as an example, Mum and Dad, John and Jan, I've knocked them off, okay? They've passed away. That black triangle there is simply the estate of the last of them to pass away. And the question here is, what have they done with their estate? Because they've got 3 kids. Now, the first 2 kids, those blue lines, so the sister and brother of Jamie, they simply get their share, okay? And then they're in control of their share. But for Jamie, the green line there, that green triangle is simply a testamentary trust, which is a protective trust. So that's just to highlight what I just mentioned there, so that the estate is still split into 3 ways, for example, but for Jamie's third share, it's into that protective trust. Pretty easy. Make sense? Okay, good. Let me move on to the next strategy then. Special disability trust. Do you know what these things are? Okay. These things, where you want to preserve Centrelink, are a must. And the Department of Social Securities, if you want to know more about this, they have a terrific booklet called Getting Things Sorted. It's actually called Special Disability Trusts, getting things sorted. So if you'd like to know more about it, just Google that. It's a tremendous thing to read. Getting things sorted. And the idea of this strategy is that we can set it up now, during your daughter's lifetime, for example, but not many of us have a lazy $800,000 that we can use to plonk into a trust now. So often in the estate planning side, we do it within a will, so a testamentary trust. So it means that again, in your will, we've set up this special disability trust, we've plonked in an amount of money in there, and we get the benefits from it. So just to explain what this does, the whole driver behind a special disability trust is to preserve the Centrelink pension. Because what this is, it's a model trust deed, and what this allows us to do is, see that figure there? Plonk in $636 odd thousand into that trust. And that amount of money is not counted for Centrelink means testing purposes. Okay? So you see, therefore, the reason why we'd use this trust if you want to preserve the Centrelink. So the idea there is that, again, we can plonk in that 636 odd grand, and that, by the way, that is adjusted each year. So that's why it's a weird figure. It started off many years ago as 500. It's adjusted each year. Okay, so next year it'll be about 650 or something like that. And again, the idea is it's disregarded for the means testing. But also, most importantly, any income coming from that lump is not counted for the income testing either for Centrelink. Okay? And thirdly, also most importantly, where there's a trust, this special disability trust, where income is not used, where it says they're unexpended, where it's accumulated within the trust, normally we have to pay penalty rates of tax, highest marginal tax rate. But in this case, we get a free kick in that we can accumulate that income, so add it to the capital of the trust, and it means that, again, that is not taxed at penalty rates, it's simply taxed at, in this case, Jamie's rate, which won't be much at all. Make sense so far? So you'll see, therefore, a fantastic tool to use where you want to preserve that Centrelink benefit. Now the big but is, does your daughter therefore qualify to get this sort of trust? And you'll see there, the second bullet point there, to be eligible, she must meet the definition of that severe disability. Now again, I've given you the section there, I won't go through what it is now because it's fairly broad, but in most cases I imagine, yes, of course she would. Okay? So again, I can't say for sure, and what we do as at the very start of this strategy is make sure that yes, she can. Otherwise, we're going down this route and we're wasting time. So we get an assessment, okay, from a doctor, for example, to say, yes, of course she can. So assuming that she does, again, it opens up a whole world of options if you want to preserve that Centrelink pension. Now, the downside of this sort of trust is that it can only be used for a certain type of thing or things. And you'll see that bullet point there, must provide for care and accommodation. That's the downside of this sort of trust. It's actually prescribed as to what it must be used for, care and accommodation. There is a small amount of a discretionary spend, but that's only $11,250 per year. That's what it is at the moment. Again, it's adjusted slightly. But that's not a lot, is it? So say, for example, your daughter needs a bit more care in a certain area, for example, or an operation, then do we have that extra spend for that? And that means that no, we're limited by those funds. Okay? And again, an independent trustee, that's part of the consideration because these sorts of trusts can go on for a very long time. Okay, let me explain that then in a diagrammatic way. The Special Disability Trust. You'll see there, again, brother and sister are looked after. They still get their third share or whatever it might be of the estate. But then again, mum and dad have been knocked off. The black, again, is the estate. And the red is the Special Disability Trust. And I put here there's lots of options here, which again, I won't go through this in great detail today, but the point here is that when we use a special disability trust, there's lots of options. In this case, diagrammatically, I've used the special disability trust, which have put in about $636,000, but also in conjunction, we've put in that protective trust. And the reason we've put in that protective trust as well is simply because of what I referred to before. For the special disability trust, we're limited as to what we can use those funds for, whereas the protective trust is discretionary in the way it's to be used. So that's why it's a backup lump sum. But in this case, really, we can do probably one of three things. We can have one special disability trust in the will. And that means we can plonk in, say, $900,000. And of course, if we did that, we take out the first $636,000, which only leaves about $274,000. Now, that means, of course, it's that $274,000, assuming Jamie doesn't have any other assets, that $274,000 is what's means tested. And therefore she would still get the full pension based on that. And it means also if we have $900,000 in there, still any income being produced by that $900,000 is again not counted for her income testing purposes. So that's one strategy. The other strategy is we have one protective trust, of which within the terms of the protective trust we can set up a special disability trust as well. Okay? Or the third option is having these two, okay, where they work in conjunction. Does that make sense? Good. Okay, let me come then to super. Now this super, as I say, is very much cutting edge when it comes to estate planning. And I'm not blowing my own trumpet there, it just means that not many estate planning lawyers will understand and have the ability to put this option in front of you. Okay? Now the idea here is that let's use the super. Let's use the super to look after Jamie. How can we do that? Okay, because normally, who can receive a pension from your super on death? Normally it's only your spouse or partner. Children cannot receive that pension if they are over the age of 25. Now what that means is that under the normal pension rules, yes, you can have a child pension through super. But once that child hits 18, that child can pull out that super. And once that child hits 25, you can't have that pension anymore. They're what's called forced to commute. They're forced to pull out that lump sum out of super. Under a certain section of the Act, Section 8 there, it means that where we have a child like Jamie, and I should use the term child, even if she's over the age of 25, because she's defined to be have a permanent disability under that section of the Act, it means that pension can continue past that age of 25. Now, why is that so important? It's because that super often, that pension is often tax-free. Now I've got there in that second main bullet point, question mark tax-free, because it really depends on how old mum and dad are. Okay? If John and Jan in this case, they're over 60, then even though Jamie might be 26 years of age, because mum and dad are over 60, she would receive a pension tax-free directly from super for the rest of her life. And you can't do that with the other two children. So that's why it's really important that we get advice about this super side of things as well. Now, I know it's late in the day, all that will sound like Swahili to you. Okay? Let me explain that in a diagrammatical way. Before I do that, Centrelink. With Centrelink, you would not go down this route if you want to preserve the Centrelink. Okay? Because all that super sitting behind Jamie's pension would be attributed to her for Centrelink purposes. Okay, so I'll say that again. If you're looking at preserving Jamie's Centrelink, in this case, you would not do this. Okay? You'd use that special disability trust and the combination of the protective trust. Okay, let me explain in English what this all means. Again, John and Jan, mum and dad, have died. That's their estate. In this case, John and Jan, or the last of them to die, had a lump of money in super. Remember, they had $1 million each, $2 million, okay? And again, I've plucked that figure out of the air. The pension, John and Jan have a pension, which they get during their lifetime. But what they can say it's John's gone first and Jan goes second, Jan can say on her death, my pension reverts to my daughter Jamie. And if she does that, then again that pension comes directly from the super fund, not from the estate, from the super fund to look after Jamie. See those there? Okay. The son and the daughter, okay, they're looked after independently. But for Jamie, we've then got, again, a protective trust because we want the income stream coming from the pension into that protective trust within the will. What we can also do is pay a lump sum in there directly from the estate so that she's got some play money, okay? But again, that's a protective trust. It's not hers to use as she wishes. Again, it's that trustee. Whoever is the trustee is in control of those funds. So the point here, as far as that income stream is concerned, that we have what's called a small APRA fund. Think of it like a self-managed super fund, but an independent trustee. That is a strategy you'd use in this particular case, because only in that way can we ensure that that super is used for Jamie only. Again, you'll be getting pretty confused at this time of the day, but I'm just highlighting what it can be used for and how it works. But the point here is that we're using the super fund after the death of mum and dad to provide that pension stream, that income stream to Jamie, absolutely tax-free, which we only get because Jamie is under the circumstances she is at the moment, okay? So it means that, again, her brother and sister can't get that. It means we have the opportunity to look after Jamie because of her condition, of course, which we don't have for the other two. Okay, so it's a unique opportunity to use in this particular way. Let me finish up. I know, again, I've thrown that at you. That'll be a bit confusing, but again, I'm simply throwing ideas your way. That's it. I know the time, Bill.
Yep, maybe 3 or 4 minutes possibly for questions if you have them.
I'm happy. Yes?
That's if you've got liquid assets. What if you have objects or things that you want to...
It works in the same way. Okay, so whatever you own will pass through your estate. And it's a matter of drafting your will. You can do, like a normal will, you can do certain things with those assets. Okay, just like a normal will. Yes?
Assuming you set up the trust, what happens immediately after death? What's the mechanism of implementing it?
Which sort of trust? The testamentary trust?
Yeah.
Yeah, okay. So remember, a testamentary trust is simply a trust set up in your will. So you would have heard of the term probate. Okay. Probate simply means that the executors get the right, so they apply to the court, they get the right to disperse the assets in accordance with the terms of the will. So whether it's a standard will or a testamentary trust will, the process is exactly the same. The only difference is when the executors are about to pay out the shares of the estate, instead of just handing it out to, say, Jamie, a trust is set up for her at that time. Now, what's most important...
So that's an additional trust, over the trust.
Yeah, so
Before death.
that's right. So there's no trust before death in this case. It's only set up after death.
And the rules are the ones. And the rules are those that were in the...
Yeah, really good question. So to answer that, it's the will which sets up the terms of that trust. So that's why I say it's all in the drafting. Okay, it can do all sorts of things, but the point there is that the will is the trust deed. You don't then need to set up a different trust for Jamie. All the drafting has been done. All we need to do at that time is get a tax file number, get a bank account for the trust, and think up some nice name for the trust. That's all. As simple as pie. Last question? Anyone? Yep.
Does that trust then need to do a tax return?
Yes. So it's a different entity for tax reasons. A trust is actually a relationship, but for the tax purposes, it's an entity. But that accounting fee is bugger all compared to the benefits that we get from that. Absolutely. Okay. Thank you, Bill.
Thank you.
Thank you, everyone. I hope you got something out of that.